Fundamental Accounting Equation, Module 1.5. Today we're going to talk about the fundamental accounting equation, which is going to form a significant foundation for the rest of our course. So this is a fairly important and fundamental topic to look at. Our fundamental accounting equation is really a relationship between the categories of accounts that we deal with on an ongoing basis inside of organizations. The fundamental accounting equation really says that what we own is a result of what we owe, or what we have borrowed, and what we have invested, or reinvested, or earned. So if we think about this logically, it tells us that all the things that we have inside of an organization come from a couple of different sources. It comes from either borrowing money, or it comes from bringing new investments into the organization, or reinvesting our ongoing operations. So we categorize this as what we call our assets. What we own is equal to our liabilities, what we owe, plus our shareholders' equity, what we've invested, reinvested, or earned. Okay. And in between here we have some different examples of accounts that are classified under these different classifications. So when we think about assets, these are things that we own inside of the organization. They include things such as cash, accounts receivable, which is customers who owe us money, our inventory, so the things that we have on our shelves, prepaid expenses, so these are things that we have paid in advance, and investments, of course, our equipment, our building, our land, our properties, plant, factory, all of those things that we actually own and physically can hold or can receive. Okay. Our liabilities, things that we owe, we classify those under a different category. So the more obvious are kind of loans, mortgages. We also categorize bonds payable. We've talked about bonds briefly in past lecture, but again, a bond is just a contract that says we need to pay someone back some money with interest. We also have accounts payable. And accounts payable is really an IOU that customers owe us now, that we owe our suppliers. So we've gone out and bought something and said, I'll pay you in 30 days. So that would be an accounts payable. It's something we owe. And notes payable, again, a slightly more formal payable. And then we have our shareholders' equity. So what we've invested, what we've reinvested, what we've earned. So some categories in here would include common shares. So our common shares are the actual shares that we've given to shareholders or investors in exchange for money that they gave the organization. We also have what we call retained earnings. And retained earnings is really what we've reinvested inside of the organization. So year after year, we have revenue and we pay expenses, which gives us a profit. What we do with that profit is really dependent. So we could reinvest the profit in the organization in what we call retained earnings, or we could pay that profit out to shareholders. So we could pay it out to our investors in the form of dividends. And so all of those different sort of account names inside each of these different categories of accounts is going to start to form the foundation of our course. So how we work with the accounting equation, so there's a few different ways to look at this. So let's look at a sample transaction here. So we have Verizon who's borrowed money from the bank to purchase a new cell tower. So let's think about what's happened in this simple scenario. We now own a brand new cell tower, and we now owe the bank some more money. So if we put this back over top of our accounting equation, remember that our assets always have to equal our liabilities plus our shareholders' equity. So in this transaction, we've increased our assets on the left-hand side of the transaction, and we've increased our liabilities on the right-hand side of the transaction. And there was no change to our shareholders' equity. And so for whatever amount we borrowed and whatever amount the cell tower is valued at, our assets and liability have both increased in equal increments, and our accounting equation is still in balance. Let's think about this as well as our personal accounting equation. So think about how you would go about buying a car. So when we buy a car, we're taking on a new asset. We now have something new that we own. And there's a few ways that we could do it. We could sell something. So we could sell our old car to buy a new one, in which case we no longer own one asset and we now own a brand new one. So if we think about the accounting equation, on the left-hand side, our assets increased by the same amount that our assets decreased. We could borrow money from the bank. We could increase what we owe, increase our liabilities, and we'll now have a brand new car. So our assets have also increased. So thinking about our accounting equation, the left-hand side, our assets have increased at the same level of our liabilities increasing on the left-hand side, on the right-hand side of our equation. Or we could take on a job to earn the money. So we could go out and work a job that's going to give us just enough money to buy that car. And so again, we now have the brand new car. Our assets have increased, and our shareholders' equity has increased. Or we've generated revenue and reinvested it in ourselves. Sort of a far stretch to our accounting equation, but we could think of it in that respect as well. So again, we see both the left and right-hand sides increasing equally. Let's do a couple of examples here. So if we have Go Green Enterprises, and we know the following information. We know that they have assets of $3,000 and liabilities of $2,300. We're asked to calculate what the shareholders' equity value would be. So again, if we think about this, we know that our assets are equal to our liabilities plus shareholders' equity. We have assets of $3,000, which are equal to liabilities of $2,300 plus shareholders' equity. So we can now solve simply for our shareholders' equity, and we know that we have shareholders' equity of $700. Again, this equation fundamentally is always in balance. Okay, let's take a look at another exercise. We have XYZ Corp that has the following information beginning of the year. We had assets of $100,000, liabilities of $80,000, shareholders' equity of $20,000. We had a few things happen throughout the year. And so now we want to calculate the accounting equation for the end of the year. Let's take a look. Let's start by setting up our assets, our liabilities, and our shareholders' equity. So at the beginning of the year, we had assets of $100,000, we had liabilities of $80,000, and shareholders' equity of $20,000. And we see that this was equal indeed. During the year, we purchased assets of $60,000. We had an increase of $60,000. We borrowed some money from the bank, so our liabilities went up. We don't know by how much. And we earned $45,000 in income. And so we'll assume that we reinvested that income. So our shareholders' equity went up in what we call retained earnings. And so now we can calculate our accounting equation at the end of the year. So in total now we have $160,000 of assets. We have $65,000 of liabilities. And so we must have $95,000 of liabilities. And this would ensure that we are equal again. All right, so continue to work on some of the self-assessment exercises and the recommended problems. And we'll work through some additional problems through our tutorials during the week. Thanks so much and have a great night.